Hello students, welcome in Companies Act 2013 amendments which are applicable for November 2021 exam. So November 21, I know that it is now postponed and now the exam is likely to be conducted at December 21, but there are few amendments which are very important for our exam. We are going to learn about this. What are those amendments? Let's have a look into this. Look, in this material, chapter wise, I have categorized few important exam oriented amendment जो हमारे कंपनी लॉ के पेपर में आ सकता है. चैप्टर वाइज देयर आर सम अमेंडमेंट जो हम समझेंगे विद एग्जांपल्स दैट हाउ टू इंटरप्रेट the important amendment. Now look, few amendments which are penalty oriented I have not included here because basically जब हम बात करते penalty की, so penalty means what? Earlier there was some different penalty and now there is a different penalty. That kind of amendments we can easily do just by reading them. So those I have not included here. I have included only those amendments from which there can be question in exam, and generally it is the trend of ICAI that whenever there are amendments they definitely do ask questions from them. All right, so let's start with the amendments from chapter number 1. So basically from the chapter number 1 we have two different amendments. The first one is section 2 subsection 52 about listed company, and the second is small company. Two important amendments. What is there in? Basically let's have a look into that. So first amendment over here, it is the definition of listed company, what is provided under section 2 subsection 52. So first of all let's understand that what is the amendment. What is listed company first of all? So if we read section 2 subsection 52, it clearly says that listed company means a company which has any of its securities listed on any recognized stock exchange. So this definition is as it is, just before, no any changes taken place, that any company whose securities are listed in the recognized stock exchange, it is a listed company. And now the question is, sir, what is the amendment? Look, under section 2 subsection 52, amendment mainly says that which are the companies which are not listed company. That is the amendment. So now from this definition, what kind of question they can ask? They can simply ask that from the given below list, which companies are listed companies and which companies are not listed companies. Okay, so what kind of question there can be? Let's understand the question first of all. Okay, and then we are going to learn that how this amendment helps us to solve this particular question. Suppose it is said that following are the companies, explain whether it is listed company or not. The first one is, let's say, ABC Limited, and this company has 100 crore rupees preference share capital, okay, which is listed in Bombay Stock Exchange. Second company is, let's say, XYZ Limited, and this company has somewhere around 50 crores equity shares capital, okay, which is listed at National Stock Exchange. All right, third company over here, which is, let's say, PQR Limited, and this company has somewhere around 25 crore rupees debentures, that means the debt, which is listed in, again, Bombay Stock Exchange. So whether it is known as the listed company or not. Fourth question is very important. Suppose it is, let's say, Ajay Limited, and this company is 25 crores equity share capital plus 20 crores preference share capital, which is not listed in any stock exchange, but this is very important, but it has somewhere around 25 crore rupees convertible debenture which are issued on private placement basis, but listed in Bombay Stock Exchange. Okay, look at this question now. So whether out of these four, which company is considered as listed company, which is not? All right. So let's understand. ABC Limited has 100 crore rupees preference share capital listed in BSE. XYZ Limited 50 crore rupees equity share capital listed in National Stock Exchange. PQR Limited 25 crore rupees debentures listed in Bombay Stock Exchange. Ajay Limited total 45 crores, 25 plus 25, not listed in any stock exchange. But this line is very important here. It says that 25 crore rupees convertible debenture through private placement listed in Bombay Stock Exchange. Now here very important question comes, if we raise any funds through private placement, can it be registered under stock exchange or not? Answer is yes. Even though it is private placement, it can be registered under stock exchange. So here we have to see section 2 subsection 52 exceptions, that which are the different companies whose securities are even though listed in the stock exchange but still they are not listed company. Okay, so let's have a look into this section 2 subsection 52. So it says that listed company means a company which has any of its securities listed on any recognized stock exchange. Section 2A further says that companies not to be considered as listed companies for this proviso of section 2 subsection 52. That means the following classes of companies shall not be considered as listed companies. So total there are A point and B point. A point is about the public companies, whereas the B point says about the private companies. Okay, in the A companies, for the public companies, these three different categories are considered as non-listed companies. What first it says? Public companies which have not listed their equity shares on a recognized stock exchange but have listed there. So look, this word is very important. First condition is their equity shares are not listed in any stock exchange, but either of these three is listed, still it is non-listed company. What first says? Non-convertible debt like debenture issued on private placement basis as per the terms of the SEBI regulation 2008. So what does it mean? That equity shares are not listed, but non-convertible debt through private placement, if it is listed in the stock exchange, it is non-listed company. Second, it says if equity shares are not listed but non-convertible redeemable preference shares which are issued on private placement, if they are listed, still it is non-listed. And third point says either A and B. What we have learned? Equity shares are not listed, but any security, whether it is non-convertible debt or non-convertible redeemable preference shares, if they are issued on private placement basis and it is listed, companies are non-listed. So formula wise, if you want to understand, we can see that equity share capital non-listed plus if any convertible debt plus private placement, yeah, that means through private placement if we have issued. So equity shares are not issued, but such things are issued, this company is known as non-listed here. Okay, same concept over here is the same thing I want to copy, but in the second B point it says that here B point it says that instead of now debt, here they have said convertible redeemable preference shares. By the way, in India we know very well that we can not issue any irredeemable preference shares. So if it is redeemable and we issued through the private placement, the law says it is non-listed. It is non-listed. And third, it says either A and B together. If you are doing this, then it is non-listed. All right. B point says about the private companies. It says that have listed their non-convertible debt securities on private placement basis. So basically we know that private companies generally do not have any right to go for public invitation. So if private companies have issued non-convertible debt securities on private placement basis, and if it is registered on stock exchange, still this company will be considered as non-listed company. Many students have this doubt, but sir, is it possible to register any security of private company to stock exchange? Answer is yes. If you follow the SEBI guidelines, it is possible to have this. But if it was done on the private placement basis, then even though it is registered on the stock exchange, it is non-listed company. Hope the whole concept of section 2 subsection 52 is clear. Alright, the next amendment over here is section 2 subsection 85 small company, and there is a small amendment. Basically you see that small company was the private company which had certain threshold limits. What those two threshold limits? As we know guys, it was like the first one was paid up share capital and second was the turnover. Earlier the limit was 50 lakhs and 2 crores. But now as per the amendment, students, the limit has been revised and it is increased. Now earlier the paid up capital limit had 50 lakhs, now it is increased to 2 crores. And turnover limit had the 2 crores, it is increased to 20 crores. So now student, any private company which has less than 2 crore rupees paid up capital and at the same time has less than now 20 crore rupees turnover, it is known as small company. Earlier the limit was 50 lakhs and 2 crores respectively. So now remember, next amendment is from the chapter number 2, incorporation. Now what kind of different amendments we have? So look, one person company OPC has some amendments. After then another topic we have, that is about the name clause of the memorandum. After then we have, okay, then chapter number 4 amendments will start. Okay, so first of all, over here in the OPC, what kind of amendments there are? There are two kind of amendments has been taken place in the OPC concept, one person company. First of all, if you remember, if any person wants to be the member of one person company, what was the condition? So let me tell you, what was the eligibility for membership in one person company? First of all, he should be the citizen of this country. Second condition was he should be residential to India. He should be a resident, rather I would say. He should be resident to India. Third was he should not be a minor. These three qualification was there if anyone wanted to be the member in OPC. Now here, earlier there was a provision that what do you mean by the concept called the resident? Oh, pardon my spelling here. What do you mean by the concept of resident? So it was said that any person who has stayed in India for the last year, for at least 182 days, he was resident. That what we learned. But now as per the new amendment, look here, the new amendment taken place here. As per the new amendment, now this 182 days has been revised. Okay, instead of 182 days, now law says that for the residential purpose it will be 120 days. Remember this. So earlier it was 182 days, but now as per the revised it is just 120 days. Okay, read it here. What it says that only a natural person who is an Indian citizen, whether resident in India or otherwise, shall be eligible to incorporate one person company, shall be a nominee for the sole member of OPC. So guys, Indian citizen and resident person can be either member or nominee. So explanation 1 has been provided here. For the purpose of this rule, the term resident in India means a person who has stayed in India for a period of not less than 120 days. Earlier it was 182 days during the immediately preceding financial year. Another amendment over here is about the voluntary conversion. Okay, let me tell you about the old provision first of all. About OPC conversion. Conversion to where? Conversion to any other company. Let's say if any one person company wants to gets converted into other private limited company or other public limited company, then there was a provision that until this 2 years lapsed, it was not possible. It was not possible to get converted. And if you do not want to wait for the 2 years, then you have to go with that threshold limit. Threshold limits. Now I hope students you remember that what is that threshold limit. For paid up capital it was 50 lakhs, or for turnover wise if you want to go, for the turnover wise it was 2 crores. So if you want to convert yourself to other form of company from OPC, then either you have to wait for the 2 years, and if you do not want to wait for the 2 years, then your paid up capital should be more than 50 lakhs or your turnover supposed to be more than 2 crores. That was the old provision. Now what is the new provision? New provision here from the material you can see this whole paragraph. That means the requirement of 50 lakhs rupees and requirement of 2 crore rupees turnover, that is totally repealed. Repealed means deleted. That provision they have removed altogether. That means today for conversion, right, and for conversion there is no any limit. So without any limit, students, you can convert your OPC to any other form of company. So today, even though your turnover is any turnover you have, whether it is 50 lakhs, whether it is 2 crores, whether it is 5 crores, whether it is 1 lakh only, without waiting for any period, you can convert your OPC to any other form. Alright, next amendment here is section 16 and section 13. Now what is section 16 says about? So look, while we understood the concept of memorandum, over there we had one concept, and that was that what if there is the central government's order to change the name. Okay, if somebody just complains to the central government that the existing name of the company is identical with the another existing company, so central government has a right to just issue an order that you have to change the name. So over there, within what time you should have to change it? So earlier there was 6 months, but now my dear students, this limit has been changed from 6 months to 3 months. Now the new limit over here is the 3 months. So that is section 16. So now company shall change the name within 3 months of order. Okay, when there is a central government's order and you have to pass the ordinary resolution too. What is section 13 says about reservation of name? Okay, so let me tell you about. So according to section 13, earlier there was a provision that when you just reserve the name, it was valid for 20 days. What does it mean? Earlier there was a provision that within 20 days you have to register, you have to incorporate your company by filing the necessary documents and form with ROC. But if you could not incorporate your company within 20 days, then this reserved name will lapse. Now what is the amendment here? What is the amendment? According to the new amendment, law says that okay, fine, if 20 days lapsed and if you don't want your name lapsed, then you have to pay additional fees. If you pay additional fees to ROC, okay, whatever decided amount made by ROC, then your name reservation will increase by another 20 days. And over here the additional fees has been decided by ROC is 1000 rupees. So if within first 20 days if you could not incorporate your company and still you want to reserve the name, you no need to refile any application, just pay 1000 rupees to ROC and your 20 days will be extended by another 20 days. What if this Another 20 days also got over. So here section 13 says no problem, again you pay this 1000 rupees, and again it will increase by 20 days. That means if 20 days lapse, again you pay 1000 more 20 days. Till what? Till you get incorporated. So keep on paying 1000. Law has not provided any limit that till how much time you can keep on just renewing this process. Until the law stops it, you have the right to continue this. All right. So that was the provision of section 16 and section 13. Alright, now another amendment is from the chapter 4, share capital and debentures. Now only one amendment is there, that is from section 62, further issue of share capital. So if you remember guys, further issue of share capital, particularly clause A when I talk about, so that is something about there was a provision that according to section 62 subsection 1 clause A, whenever you issue the further share capital, it must have to be issued first to the existing shareholders only. Okay, and this concept over here, it is known as right issue. Okay, and that was provided in section 62 subsection 1 subsection 1 and clause A. Now what is the amendment? So earlier it was provided that when you give notice to existing shareholders to just tell them that whether you want to buy this or not, what was minimum period of notice you could give? It was 15 days. Yeah, and maximum it could open for 30 days. That was the provision, if you remember, right? So minimum 15 days, maximum 30 days. Now what law has said that words not less than 15 days, new word will be inserted, and that is lesser number of days. What does it mean? Here they have inserted the word that instead of 15 days, any less number may be announced by the central government. So earlier it was 15 days, now it can be lesser number. But here student may think that, but sir, what is that lesser number? So write down the new lesser number over here is 7 days. So earlier there was 15 days, now it is 7 days. What does it mean? So now my dear friend, company, if wants to give the notice, now minimum 15 days, no need to give. If company wants, it can start with 7 days. Start with 7 days. Alright, earlier it was not less than 15 days, but now you can start with 7 days. That is the new amendment. Alright, so 7 days is the minimum number of days, and maximum it was 30 days. Alright, next amendment what we have here, it is from मैनेजमेंट एंड एडमिनिस्ट्रेशन, मतलब ये जनरल मीटिंग वाला चैप्टर है, ठीक है. सो ओवर हियर वी हैव ओनली वन अमेंडमेंट एंड दैट इज इन द एनुअल रिटर्न. नाउ व्हाट काइंड ऑफ अमेंडमेंट्स आर टेकन प्लेस? सो हियर look, annual return means what? When general meeting gets over, it was company's duty to submit certain details by filing the form MGT7 to Register of Companies. Now, as per the new amendment, they have said that certain details you don't require to provide and certain new details you have to insert. So what are those different amendments? Let's understand. First, it says that every company shall file its annual return in form number MGT7. So this is the as it is thing. Even earlier there was MGT7 form, now again it is MGT7. But what is the amendment? This is the amendment, except for OPC and small company. Why? Because they have said that for OPC and small company, instead of MGT7, they have introduced new form, that is MGT7A. Now they will file MGT7A. So comparatively, if you see now, MGT7A contains the less information to be provided to ROC than MGT7. All right. So over here only one clarification, and that is new form MGT 7A has been introduced, which contains the less information to ROC to the government, and that will be applicable to OPC and small company. Now another part of section 92 amendment is that certain details will be deleted while you file annual return under section 92. Earlier, while you were used to file annual return, you had to give the lot of information about the in-depthness of the company, particularly about foreign institutional buyers. Law says that clause C shall be totally omitted. Okay, basically I consider this point as relevant, but not as much like the other important points, because it just is about the annual returns content. Okay. Second, it says that in the clause J, the words indicating the names, address, countries of incorporation, registration, and percentage of shareholding held by them shall be omitted. Now, what does it mean? Look, if you see now, all this information in this paragraph is for the foreign institutional buyers. What does it mean? What does it mean? Earlier, there was a provision that when foreign investors, if they were investing in the particular company, that information had to be filed, had to be given in annual return. But now they have said that clause C, that means in-depthness of those foreign institutional buyers or investors, will not be provided. Not into that, certain other things like address, their countries of incorporation, their registration, their percentage shareholding, this thing will also be omitted. Omitted means this will not require. Now, this is also not required to be given to ROC. Now, what does it mean? If you read this 2 point now, by putting this amendment, actually the government has liberalized certain provisions towards the foreign investors. They said, okay, no problem, you simply come to our country, invest in our company, do your business, we will not ask much information from you. Earlier, government was used to ask, but now it is not. So it is just one kind of motivational factor for foreign investors. Then new point will be inserted. It says that provided further that, so new proviso has been inserted. What is that? The central government may prescribe abridged form of annual return for OPC, small company, and such other class of companies as may be prescribed. So this paragraph, if you see now, already we have covered up that instead of MGT 7, new abridged form is introduced for the one-person company and small company. And what is the name of that? It is Form 7A. All right. And this is very important amendment, third amendment. Earlier, what was the requirement? Whatever details you have provided in annual return, we had to provide that into board report. That means extract of annual report had to be given in board report in the past, but now it is not required. Now it is not required. This requirement that extract of annual return, which was used to be given, now no need to be given in the board report. So these are the some different amendments for general meeting, and most of the amendments are just related to annual return and nothing else. Next amendment is from chapter number 9, accounts of the company. So basically there are 3 different amendment has been taken place. The first is from the section 128, some amendment taken place in the rules. Section 129A, this is the new section inserted, and third is the section 134, which is about the board report, and over here few more details will be provided. So what are these 3 different amendments? Let's learn about it. First of all, section 128 says about maintenance of books of company, books of accounts of the company. So what is the new amendment? So first of all, let's learn about the old scenario. So according to section 128, every company had a right to use any software to just pass the journal entries or just to put the accounts. But in the software, there were certain features which were making the transaction easy to manipulate. How the people could manipulate? They could easily modify without trace. They could easily add new things without tracings. they could easily delete the transaction without any tracing. And when it is detected that accounts are manipulated, it was very difficult to trace, because generally software does not carry any kind of tracings behind. Now section 128, in this rule, as you can see over here, the company's accounts rule 2014, rule 3, in that sub rule 1 has inserted new paragraph. They have said now that if company is using software, now this software, now company can use only that software which must contain the traces. Look, the traces here are used in the name of audit trail. The word what they have used in the paragraph is the audit trail. Now what is audit trail? We know very well, right? According to the information technology, the trail can be maintained by maintaining what? The log file. Now technically speaking, what this paragraph is trying to say, it tries to say that now any software what you use, it must contain all the traces regarding all the additions made in the transactions, all the kinds of modification made in the transaction. Not only to that, if any transaction is deleted, who deleted, why deleted it, what kind of time it was deleted, all the details must have to be maintained by one log file. This log file must have to be maintained in that software. If the software does not maintain that, then it is the duty of auditor to report in his audit report that whether such log file is contained by the software or not. So look, what I can say, the revolutionary step actually exercised by the central government, that you cannot use any software which doesn't contain any log file, which does not contain any traces. तो आपको वही सॉफ्टवेयर यूज करना है जिसमें ये traces हो, log file हो. So in case of any manipulations, government can easily trace it out that who was the person behind this all manipulations. Alright, read this. What it says: provided that for the financial year which is coming from the April 2022, every company which uses accounting software for maintaining its books of account shall use only such accounting software which has a feature of recording audit trails, so which has a feature to record the log file of each and every transaction, creating an edit log of each change made in the books. So whatever change you are making over there, whether you're deleting, whether you are modifying, at the back end that log file must contain each and every detail along with the date. Got it? And we have to ensure that these audit trails should not be disabled at any point of time. So no one can disable this particular audit trail. So very soon, students, we are going to see such softwares in the market which must have to have audit trails. Without that, it is not possible to use by the company. So it's a wonderful revolutionary step taken by the central government. We should welcome it. Next amendment, what is here? It is section 129A, which is about the periodical financial results. Now, what do you mean by this 129A? So earlier, if you remember, if we talk about the listed company needs to publish an audit. Look, two words I'm using: audit and publish their financial statements, not once in a year but once in a quarter. So one quarter completed, audited it and published into vernacular newspaper. It is compulsory for listed company. But now section 129A inserted in Companies Act. What does it mean? Look, this provision was there that every listed company has to publish their financial statements, audited financial statements in newspaper. It was the SEBI rule, not Companies Act. But now 129A inserted for the Companies Act. What it says? That the central government will prescribe. Central government will prescribe certain companies. Now, how central government prescribes? Either by giving the notice or by putting certain criterias. There are all those companies whose criterias are filling here. Now they must have to publish their financial statement the way a central government instructs. So let's say for few companies, if central government says that you have to publish your financial statement not in once in a year but once in 3 months, even though you are not a listed company, company has to do that. So student, now it is possible that company may have to go for audit maybe within 3 months or the 6 months, the way central government instructs. Got it? Even though it is not listed. All right. So if there is a question in exam that there is a company called ABC Private Limited which maintains the books of accounts yearly basis and also do the audit on yearly basis, is it required for this company to get the books of accounts audited once in a quarter? Explain as per the amended Companies Act 2013. So understand over here, it may possible only in the case when central government instructs, directs. So when central government directs, issues the direction, and this company falls into that limit, then it becomes compulsory, it becomes mandatory. Until it is issued, if you want to get it audited, you can go voluntarily. You can go voluntarily. You can go voluntarily. All right. So this is about 129A. So it is written that the central government may require, so it may order any class of companies, of unlisted companies, to prepare the financial statements or the results on such periodical basis and in any format what central government directs or instructs. All right. So this is about 129A. Now what is this 134 is about? 134 says that while now company prepare any board report. So basically we know that according to the board report we have to add the lot of contents there, lot of inclusions are there. There is the whole format in the Companies Act that what should be included, what should not be. It is provided there. Just two more information we have to add, and this will apply only in the case when company has applied for bankruptcy. So look, the first paragraph it says that look, the following clauses shall be inserted. So new two clauses has been added in the board report. The details of application made or any proceeding pending under the Insolvency and Bankruptcy Code 2016 during the year or till the financial year end. So whether you have applied for bankruptcy, if you have not applied, if it was applied in the past but not completed yet, that means if it is pending, that detail also has to be provided in the board report that they have applied for insolvency and the bankruptcy as per the Insolvency and Bankruptcy Code. Alright, so it's detail about the bankruptcy in a nutshell. Second paragraph is very important. What it says that the details of difference between amount of the valuation done at the time of one-time settlement and the valuation done while taking loan from the banks or the financial institution along with the reasons thereof, that we have to provide. Now many of you may think that what is the new in that? Okay, you tell me one thing. If any company goes to take loan from the bank purposefully, what it will do? Will it increase the value of assets or it will show less values? Answer is, if you want to take the loan from the bank, obviously company will try to show more value, because the more value means more net worth means bank will get impressed by that and it will give more loan. So basically it is the general tendency of all the companies while taking the loan, they are trying to show more and more value of their assets. But at the time of insolvency, at the time of settlement with the creditors, company will cry. Company will say, "Arey Baba, मेरा इतना पैसा ही नहीं है, अपना पैसा भूल जाओ ना." Company will always try to say that I don't have much assets, I do not have much value of the assets. Please forget your money. Please try to reduce the portion of your money. Here law says why you should have the double standards. While taking the loan, you are showing the more value. While settlement with the creditors during the bankruptcy, you are trying to say the less value of the assets. How come it is possible? Look, law doesn't say that you cannot show the two different values. Law says fine, you can, but that difference you have to mention in your board report. That why you are doing this. लोन लेते टाइम पे अलग वैल्यू है, इंसॉल्वेंसी के टाइम पे अलग वैल्यू, तो ऐसा रीजन क्या है उसका? Now actually, if the board puts the real data into board report, they will get exposed. It will be proved that while taking the loan, purposefully you have overvalued the assets, which is against the law. It is just like a fraud. So it is just like a trap. You know, this paragraph is the trap. अब जानबूझ के आप डबल स्टैंडर्ड मेंटेन नहीं कर सकते. It will be difficult for you. And if you are trying to maintain, you can get easily exposed. And once you are exposed, it is very easy to prove whether you have made fraud with the banks or not. All right. So that was the amendment for section 128, section 129A, and the last one is section 134. Next amendment is about chapter 10, Audit and Auditors. So most of the amendments which are taken place over here, it is under section 143 subsection 3. What is 143 subsection 3? It provides auditor certain responsibilities to report on certain matters. You know, that whether books of accounts are properly received or not, branch returns are properly taken or not on periodical time, and there are a lot of other assertions, you know, whether personal expenditures of the director are debited to profit and loss account or not. A lot of different assertions were there. Auditor needs to check it and just needs to report it whether it is proper or not. In that, these many points are additionally inserted. Point number E. In the E, there are two paragraphs, 1 and 2, okay, and 3. And next point is the point number F and point number G. Let me discuss first about point number F and point number G. What it tries to say. It says about the duties of the auditor to report on certain matters. It says that whether the dividend declared or paid during the year by the company is in compliance with the section 123 or not. Look, earlier this point was not there. Now it is the duty of the auditor to check whether dividend is properly paid according to section 123 or not. If it is not paid, auditor has to report it here. G point says it is the auditor's duty to verify whether the company has used any accounting software for maintaining its books of account which has a feature of recording audit trail. So if you remember, the same thing we also did in section 128. Sorry, not section 128, but if you, yeah, sorry, it is 122. Yes, section 128, that now company has to use those softwares which has the audit trail. Now here the same thing is crossly given under section 143 subsection 3, that if company is using such software, it is the auditor's duty to verify whether it has the edit log, yani ki audit trail or not, log file or not, which contains all the manipulations and the changes, and which should not be disabled by anyone. It should not be capable of being deleted or disabled by anyone. So auditor needs to report on that what kind of facility it has, what kind of software they are using, whether facility of log file, maintaining log file is properly given up there or not, whether anyone can manipulate that or not, etc. Now coming back to here, point number E. In the point number E, if you see that two paragraphs are there. What first says, it is the duty of the auditor to receive what representation from the management. That means whether the management has represented that to the best of its knowledge and belief, other than as disclosed in the notes to accounts, no funds have been advanced or loans. और बाप रे कितना ज़्यादा है यहाँ पे. What this paragraph tries to say, let me tell you the fundamentals. Look, sometimes what happens, suppose there is a company, let's say it is A Limited. Now A Limited has certain funds. It wants to help another company which is the sister concern. Alright, so directly if it will invest the money into sister concern, shareholders will have doubt on it. because ultimately it is the shareholders' money, shareholders' funds. Why you can directly invest these funds to the other sister concern to benefit your relatives? So generally, such kind of investment, how they're proceeding, such companies are hiring some mediatories, certain mediator people. Suppose let's say we have hired some investment company here. So first of all, this company A Limited will transfer all the fund to this investment company, and now this investment company will further transfer this investment to B Limited. Now look, if this kind of things is easily allowed, there are more chances of manipulations. Your company can directly say that we have not directly helped my sister concern. We just gave our funds to some investment company, and the investment company invested in the other companies beyond my control. So this argument could be given by A Limited over here in order to avoid this. Now two responsibilities are imposed on the shoulder of the auditor. Now they need to actually give the assertions on this 2 point. Point number 1, auditor needs to take the representation from the company that they have not advanced these funds to any such mediatories, whether it is foreign investment company, Indian investment company, or any kind of middle person, so that to invest these funds to another company. If you read this entire paragraph, the meaning of this thing is only one. By hiring some middle companies, middle organizations, you are not trying to provide any indirect benefits to other association, other company or other organization. That means in case if the company wants to invest, they can go directly. And if they want to go directly, there are a lot of restrictions are there for the intercorporate loans. So in order to avoid such manipulations, this provision is inserted that it is the duty of the auditor to get the management representation that they have not given the funds to any mediatories, so that they can invest the funds to other company. Second paragraph, they have to say that suppose in this example investment company's name is XYZ, suppose XYZ Limited. So if let's say auditor is going to audit the books of accounts of this middle company, auditor has to take the written representation from this company as well, or all the companies, that they have not taken any funds from any other company to invest in other company. That means indirectly I want to say auditor has to take this representation from the management that they are not playing the role of any intermediary getting the loan from the other company and investing into other company. They are not playing the role of any intermediary. That representation they have to take. So if you just compare these two paragraphs, by the way, these two paragraphs are inserted to control the indirect investments, just to stop the manipulations. Got it? Next major amendments are taking place, that is under section 135, that is the corporate social responsibility. Alright, now what it says, first it is taking place under subsection 5. What it says, that the company satisfying any condition of section 135 subsection 1 for any financial year shall make CSR expenditure of 2% of average net profit of the last 3 financial years. So if you see guys, this paragraph says that if any company when qualifies to go with the CSR, you know, all those threshold limits were there, then it has to go for the 2% of the average net profit. And how this average net profit will be calculated? We know that we have to take the last 3 financial years of profit we have to take. So till this there is nothing. Or now here this is the amendment. What it says, where the company has not completed the period of 3 financial years since its incorporation, during such immediately preceding financial years in pursuance of its corporate social responsibility policy. Now what does it mean? Look, there is possibility that some companies have completed just the 2 years. Now how this average net profit will be calculated. Law was silent in the previous section 135 subsection 5, but now in the new amendment they have given the solution. Now here there is a chance to ask the question. Understand, now if any company after its incorporation suppose has completed only 2 years. Let's say one company is there which has completed financial year 1819 and 1920. In the year of 2021 they have to calculate the CSR. So obviously this company has completed only 2 years. Over here the profit was 2 crores and here the profit was suppose 3 crores. So now how this 2% will be calculated? So over here law says that if company has not completed 3 years, then you have to take the average of whatever year is completed. So here only 2 years are completed. So how the 2% will be calculated? First of all, you have to go with the average. So average will be here 2 plus 3 divided by 2. So what it comes? 2 plus 3 divided by 2. So that comes to 3.5. Oh, I'm sorry, not 3.5. 3 plus 2, that comes to what? 5. So 5 divided by 2, that comes to 2.5. So 2.5 crores will be the average profit, and 2% of this 2.5 crores will be considered as the CSR fund, CSR amount. Alright, so that will come somewhere around 5 lakhs, right? Okay, what next paragraph says? It says that provided that if the company fails to make the CSR, this is very important in the major amendment taken place over here. What it says, if the company fails to make the CSR, the board of directors shall disclose the same into the board's report with the reasons of the failure. Now till this the provision is the same, that if company could not spend those CSR amount on the different projects, now then what to do here? Now this concept, write down if you are noting it out, this concept is categorized into two parts. So unspent amount of CSR. So point number 1 is obviously it will be disclosed in the board report, board of directors report with reasons, that is there. But apart from that, two more points are there. First point, we have to categorize this CSR into 2 points. First, other than ongoing projects. Now what is ongoing project? That definition is actually provided in the definitional part. Second is whether money is related to ongoing projects. Alright, now let me tell you what do you mean by ongoing project and other than ongoing project. Suppose the company has put aside this money for hospital, and they have decided to complete this entire project within upcoming 4 years. So you see, already money is allocated for the project 4 years, but somehow you could not utilize the funds in the first year or the, let's say, first 2 years because of any reason. You want to use these funds from the 3rd year onwards. So this fund, what you want to use for from the 3rd year onwards, and for the first 2 years you do not want to use, that money actually belong to the ongoing project part. And any money of the CSR which is not related with such ongoing big projects, that is other than ongoing projects. Now treatment of both this is differently given in the new amendment. Alright, what law says about this? Look what it says, that unless the unspent amount relates to any ongoing project, So here we are talking about the first part, other than ongoing project. It is clearly mentioned in this paragraph that if the unspent amount is relates to any ongoing project, then the treatment will be different. Alright. Then refer to in subsection 6, transfer such amount to fund specified in schedule 7 within a period of 6 months of the expiry of the financial year. So if the fund is related to this and there is unspent amount, it is clearly mentioned that do not wait for anyone and transfer the funds, right now transfer the money to schedule 7 funds. Now what is schedule 7 funds? There may be certain central government funds which may be provided by the central government. They can say that okay, you do, these are the different funds, let's say Prime Minister Relief Fund or whatever different funds what central government may notify, we have to transfer that money over there. Okay. Now further it says that provided also that if the companies, okay, this part I will tell you later on, but here the question is what about this ongoing project? So look, subsection 6 says here that what is this ongoing project treatment. Here if you have any ongoing project and you have the projection that it will be completed within 4 years, 5 years, or whatever estimations you have, and for any few initial years if you cannot complete it, you cannot keep this money with you. Here law has provided that you have to transfer the money but not into any funds, but you have to open the separate bank account called the unspent CSR account. You have to deposit this money in the separate bank account if it is with the ongoing projects. And this money what you deposit over here, that you have to complete within 3 financial years. 3 financial years. 3 financial years are actually huge time, more time. Within this much time, by anyhow you have to utilize this whole fund what you have put over there in the separate bank account. In the case if you could not utilize that within 3 financial years, then later on the central government will take these funds and will use the way it wants. Alright, so this is the major 2 amendment. Again I want to repeat guys, if the unspent amount is related to other than ongoing projects, transfer to the funds as mentioned under schedule 7, and if it is related to ongoing projects, transfer this fund to separate bank account, and this money will be there for the 3 financial years. Don't forget that. Alright, so the section number 6 says that only. It says that in case of any ongoing project fulfilling such conditions undertaken by the company in pursuance of its CSR policy, then such remaining unspent amount shall be transferred by the company within a period of 30 days from the end of the financial year to a special account to be opened by a company on behalf of that to any scheduled bank called unspent CSR account. Alright, and further it says that such amount shall be spent by the company for that particular projects within what period? Within 3 financial years from the date of such transfer. So this paragraph is important. Alright, now what this wants to say, subsection 9. Okay, if I ask you the question that how company maintains the CSR policy, so it is quite easy. It says that any company which requires to follow CSR, first of all it has to create the CSR committee, and this CSR committee will take all the decisions regarding policy making, how much funds will be transferred to what project, etc, etc, etc. But here it is said that if your CSR contribution doesn't exceed 50 lakhs rupees, alright, then no need to constitute any CSR committee. So now it is crystal clear that until and unless you have more than 50 lakhs rupees CSR contribution by making the 2% calculation, then and only then you need to create the CSR committee. If it is up to 50 lakhs, you don't require to do that. So now the question is, if CSR committee doesn't require to be appointed, then who will handle the functions? It is written that the functions of such committee shall be handled by the board of directors itself. So it is a big relief basically. All right, so that was the first part of our CSR amendments. All right, in the amendment, I think one paragraph I missed out. Yeah, this paragraph. What it says: provided also that if the company spends in the amount in excess of the requirements. What does it mean? Basically, we all know that every company has to go with only 2%. But sometimes companies spend, let's say, 3.5 percentages. Actual duty was only to spend 2% of the average net profit, but now company spends 3.5 percentage. Then how will you treat this additional 1.5%? That is the question here. How to treat this additional 1.5%? So earlier there was a provision that this 1.5% cannot be carry forward. You could not carry forward it to the next year, but now it is not like that. Now there is the amendment. What it says that in case of any excess amount you have paid, any excess amount for CSR, if you have paid, then that can be set off. That can be set off for the subsequent years. You can set off this for the subsequent years. Okay, but maximum 3 years. That means you have to set it off within maximum 3 years. What does it mean? Example. So actual amount as per the 2% in this year, it comes to, let's say, suppose 3 crores. But actual spent amount here is 4 crores 50 lakhs. So what is the total amount you have spent in addition? That is the 1 crore 50 lakhs rupees. That is the additional amount you paid, which was not actually necessary. So this amount here, it's known as the excess CSR amount. Alright, and this can be set off within the upcoming 3 years. So what I'm trying to say, if the next year your liability is 3 crores, suppose this is the next year liability, next year CSR liability, then you need to spend only 1.5 crores. Why? Because this 1.5 crores can be set off against these 3 crores. Alright, now after then, the few changes in the rules. The company's corporate social responsibility policy rules 2014. Now what it says, look, the lot of amendments taken place regarding the COVID-19. Basically, when we check about the activities about the CSR, what was the provision? What were the rules? That earlier there was a provision that if you are spending this CSR for any of your business activity, then it is not CSR. Even today this provision is as it is. Okay, so earlier there was a provision, suppose that there is one pharmaceutical company, alright, and it has spent, let's say, 150 crore rupees for medicines research. So you cannot claim that this 150 crores had been spent for the CSR. No, it was for your business purpose. CSR supposed to be other than this 150 crores. But now there is amendment for the COVID-19 activities. What it says, that if any company has spent the amount for COVID-19 medicines, COVID-19 research, COVID-19 vaccination, even though you're a pharma company or medical company, then even though it is related to your business, but still it will be considered as your CSR. It's a good motivation for the pharmaceutical company. So what it says, that activities undertaken in pursuance of normal course of business of the company, provided that any company engage in research and development activity of new vaccine, drugs and medical devices in their normal course of business may undertake research and development activity of new vaccine, drugs and medical devices related to only and only one, that is COVID-19. For which financial years? From this to this. So this thing is applicable for next financial year as well. All right. And also they have said that such research must have to make with the collaboration with certain government notified institution like DRDO and certain other things. So this paragraph gives a great relief for all those pharmaceutical companies which are spending their expenditure for their business only, but just to do something for the COVID-19 in collaboration with the specified authorities, specified organizations here. Second point is very interesting. It says that any activity undertaken by the company outside India. Now this is actually very interesting. Generally, CSR does not contain any activity carried out outside India. Anything what we have spent outside India will not be considered as CSR. But here there is exception. It says that if you have spent any amount for any activity which is undertaken by the company outside India for training of Indian sports personnel representing any state or union territory, national level or India at an international level. What does it mean? Basically what happens, we know that any activity is not part of CSR, but there is an exception. What we are learning? We are learning that following activities shall not be CSR. Na? So any activity taken place outside India is not CSR, but there is exception. So this part, if you are spending money outside India for this purpose, then it is CSR. What kind of activities? Let's say there is one athlete who is participating in Olympic which is getting conducted outside India, and if you want to train our athlete from the international trainers and the coaches, and for that purpose you're sending our athletes to outside India and you're spending money outside India, law says any training of Indian sports personnel representing state or central government or union territory at the national level or international level, even though such activities performed outside India, such expenses are spent outside India, this will be considered as CSR. It will be considered as CSR. All right. So that was the something about CSR activities, inclusions and exclusions. All right. Now next part is about the subrule 1, rule 4, but subrule 1. Now look, in CSR we also understood that if company does not have that much expertise that how to spend the money of CSR, then it can take the help of expert like NGOs, then like other trusts, or like other what I can say section 8 company. Definitely company can take the help of those people. So basically these 4 kind of people are allowed. What it says? CSR implementation. The board shall ensure that the CSR activities are undertaken by the company itself or through. This through contains these 4 different points. Company established under section 8 or a registered public trust, registered society, has a 12A and ATG certification as per the Income Tax Act. Second, it says that section 8 company or any registered trust or society established by the central government, all right, or any established under Act of Parliament, or a company established under section 8 of the company or registered public trust or a registered society registered under the 12A and ATG of the Income Tax Act and having established track record of at least 3 years. All right. Now basically these 4 we are covering over. Which 4 are? with the Section 8 company, public trust, registered society. This is the A part, then B, C and D. 4 different things we are covering here. What point number 2 is trying to say? Point number 2 is trying to say only one thing, that every entity covered under subrule 1. Now understand what is subrule 1. So this you take subrule 1. In the subrule 1, 4 different entities are covered up. First of all, this entity, then this B, then C and D, 4 entities. These can be appointed to spend the CSR activities only and only when they have government license. Now maybe you are surprised, sir, what kind of license? Look, earlier, before this amendment taken place, this license was not required. Any Section 8 company having good expertise, good experience could be hired, could be appointed to spend this CSR. But now it is not like that. It says that whether it is A, whether it is B, whether it is C or D, if institute is covered up by either of these 4, it cannot be appointed until and unless they have the central government license, what they have received, that certificate they have received by filing the form called CSR1 electronically. So until and unless now this institute have the CSR1 certification, they are not eligible to help the company to spend CSR. Because in the past what happened, a lot of companies have hired the fake trust or fake NGOs and fake societies to spend the CSR money and to turn the black money into white and white to money, white to black. Just to prohibit them, now they have just made one security layer that now only those Section 8 companies, those public trust, those registered societies can be hired, can be asked for, which has the CSR1 certification. Alright, and the rest of the procedure is like how this CSR1 certification can be taken or can be considered. So this is about that. Okay, next 2 amendments of CSR is, the first is about the CSR expenditure, that is the rule number 7, and another is subrule number 4. Okay, now what these 2 kind of rules are saying about? Over here it is saying about the expenditure. It says that whatever administrative overhead we are spending, it should not exceed 5%. So basically, if we are spending any expenses to maintain the CSR activities, it is allowed. That means whatever money you have allocated for CSR, expenses will be paid only out of that, but it should not exceed more than 5%. That is the first explanation. Even this part was there in the last explanation as 2 before amendment. This part is very, very important. This part. Look, sometimes when you make the CSR activities, it creates the surplus. Now your question is, sir, how it is possible? Suppose my CSR activities is women empowerment, and for that what I have done is I have established one small industry for those women who are widow. Now they are coming there and they are making a lot of small business, like small business goods, like papad and that agarbatti, certain fragrances. They are creating some small things like pickles and all that. So at the end of the day, my project, instead of expenses, has surplus, now has profit. Now how to deal with this profit? Suppose just because of this project, now right now at the end of the financial year I have 2 crore rupees surplus. 2 crore rupees surplus. So understand, let's say earlier, suppose your liability was 15 crores, already you have paid 15 crores, and after paying 15 crores you have this 2 crore rupees surplus. So you cannot say that, okay, already I have spent 15 crores, so I can take the setup of this 2 crores. You cannot do that, company cannot do that. What does it mean? If any surplus is left there at the end of the year, law says within the period you have to transfer this 2 crore rupees. Look, it's clearly written that any surplus arising out of the CSR activities shall not form the part of the business profit of the company. So you cannot take it as a business profit. It is not your business profit. It is also considered as CSR over and above your calculated 2%. Over and above your calculated 2%. So these 2 crores will also be considered as CSR and not as a business profit, and over and above your 2%. So over and above your 15 crores as per this example. In case if you could not spend it, it is clearly written that shall be plugged back into the same project. So you have to use the same for the same project. And in case if you could not spend it in the same project, then it will be transferred to the unspent CSR account. And we learned about that special bank account called the unspent CSR bank account. The money will be transferred over there, and this money you have to utilize within upcoming 3 financial years. In case if you could not do that, then this money will get transferred to the Schedule 7 funds as specified by central government. Just now we have learnt in the previous paragraphs. So that was about this too. All right. Next rule is about the fourth. What the fourth point says? It says about the acquisition of the capital assets. Okay, example. Suppose there is a company called, let's say, ABC Limited. This company has expended certain amount of CSR activities, and it is somewhere around 200 crores. Now, if this is the huge project, obviously you will buy certain capital assets. So just to perform this CSR project, let's say it was about the education, company had to buy a building worth of rupees 25 crores. So this building of 25 crores, which is the part of education project of this 200 crores, which is CSR activity of ABC Limited, it is known as the capital asset over here. But here the question is, who will hold this capital asset? Who will hold this capital asset? Who will hold this capital asset? So law says company cannot hold it. It is not the company's fixed assets. It is the fixed asset of the public, because this money has been spent for what? The CSR. So how can company claim it? So this earlier there was no any provision there who can hold this capital asset, but now the government of India has come up with this beautiful provision. It says that the CSR amount will be spent by a company for creation or acquisition of a capital asset, which shall be held by these 4 different entities. No one else other than these 4 can have this. So first of all, any company which is Section 8 company, or it is a registered public trust or registered society having the charitable objects and having the CSR registration number by filing the which form over here? Which form over here? CSR1. So they should have this CSR registration number, and then and only then they can hold it. Then other beneficiaries of the project, whether any group or any entities, any public authority as mentioned by the government, all right, they have a right to hold it. No one else other than them can hold it. So today students, company cannot hold that capital asset. Only those entity which has the CSR registration number and other specified authorities have the right to hold that capital asset for the benefit of the society. Company cannot hold it in its own balance sheet for its purpose. The last paragraph says that, look, these rules have been implemented in the Amendment Rules 2021. But what about if the company had held these assets prior to this rules came into force? I have just to say that these are the amendment. Before that, company was allowed to use in its own name, but now company is not. So over here the law has given certain time. How much time it is given? 180 days to comply the requirement of this rule. So all those companies which are holding the capital asset before this rule came to the implementation, they have 190 days to transfer these assets to either of these authorities as specified in this rule. So hey students, this was all about our amendment. चलिए जल्दी से एक बार इसको क्विक रिवीजन करते हैं कि हमने क्या क्या पढ़ा. So first of all, we have learned about the listed companies. Over here we learned that certain securities which we have issued through private placement but registered with the stock exchange, they are not listed company. All right, small company, the limits are revised now. Okay, paid up capital 2 crores and turnover 20 crores. Residential status of the OPC now, guys, has been decreased. It is reduced from 182 to 120 days. Second, now there is no requirement to follow any threshold limit if you want to convert your OPC to any other form. Then this too, rectification of name. Now instead of 6 months, it has now 3 months when there is a central government's order. Okay, earlier there was only 20 days to reserve the name, but now by paying that 1000 rupees additional fees, you can increase the 20 days limit. Then guys, at the time of issue, the right issue now minimum number of days are not 15, but the law has made it now 7. Over here in the section number 92, for the OPC, new form is introduced, that is the MTT7A, which is the abridged version, then the MTT7, and clause C about the what I can say, foreign institutional buyers, certain details has been omitted, like its indebtedness, and the certain other details also has been taken back over here. And extract of the annual return, no need to be given in the board report. This part is very important, accounts of the company. Now 128 has inserted the new sub rule over here, that now the company, if wants to maintain the books of accounts in the software, they have to have the audit trail within the software, otherwise it will not be valid. Section 129A says that now central government can order or instruct any company to make the periodical review of the financial results and the statements or auditing. So now it is possible to get the books of accounts audited or reviewed periodically, maybe 6 monthly or maybe quarterly instead of the yearly. So it is based upon the central government's instruction. Then over here, section 134, you have to provide the details of the bankruptcy, and if there is any difference between the value taken at the time of taking the loan and at the time of settlement, you have to provide in the board report. After then, audit and auditors. So these two paragraphs is about the written representation from the management, that whether company has given the money to any intermediaries, whether foreign entity or Indian entity, to invest this money to some other companies or somewhere else. And the second paragraph is about that whether company has taken the loan or funds from another company so that it can invest the funds to different company. So that representation needs to be taken by the auditor. Other is, auditor has to check that whether while declaring the dividend, section 123 is complied or not, and it has to see that whether software whatever used by the company, it contains the audit trail or not. And then guys, the lot of amendments regarding section 135 we have learned in detail. Like now you can just set off the excess payment paid CSR. If you have CSR contribution up to 50 lakhs, then you no need to maintain the CSR committee. All right, then what if you could not spend the money within the specified time? Then if it is ongoing project, then how to do? If it is not ongoing project, then what to do? A lot of things we have done over here, certain rules and certain things. COVID-19 research with certain collaborations are allowed as CSR now. So certain activities, even though they are spent outside India, but if they are to promote the sport personnel at national level or international level, then it is also considered as CSR. That also we have learned over here. Few part we have learned that now you have to take the CSR1 license. If you want to get the support of any NGO, section 8 company or any trust to spend the CSR amount, then now any institute which does not have CSR1 license cannot be your collaborator. That also the new wonderful amendment taken place. Then we have learnt about what if there is a surplus expenses and capital asset, how to deal with that. So hey student, that was all about our November 21 company law amendments. In case of any query, please let me know on that. Thank you very much.